Welcome to the Retirement Roadmap by SHP Financial, a podcast empowering today's retirees and pre-retirees to make well-informed financial decisions that will help you spend more time living and dreaming than worrying and wondering. Join me, Matthew Peck, along with my co-hosts, Derek Gregoire and Keith Ellis, as we share actionable financial strategies and insights, as well as interview top thought leaders in the world of finance, accounting, and estate planning. This is all aimed at preparing you for the retirement you've always dreamed of. Our high-quality holistic planning process has helped thousands of families retire and create what we like to call the ripple effect. The Retirement Roadmap is your guide to financial freedom. Are you ready to get started? Let's go.
Hello, everyone, and welcome to a very special episode of our SHP podcast. We are celebrating our 100th episode, and we are here live in the SHP office recording, and we have our fearless leaders here, Keith Ellis, Derek Gregoire, and Matthew C. Peck. Hey, guys, how you doing today?
Good, how are you?
I love the C.
Yeah, it's always Matthew C. Peck.
Oh, absolutely.
Yeah, there's no other
it makes
way.
it much more official. Like, no one would respect me if I didn't have
Correct.
a middle initial.
Yes,
so you're really going to
correct.
drop that.
Well, today, guys, we have a lot that we're going to unpack, and I think, just having 100 episodes under your belt, I just want to first start and ask you guys, how does that feel?
I'd say it's something we've obviously been doing radio for years, and started doing that back in 2007 or so. And as we got going with that, we just figured, next step is podcast. We didn't know what a podcast was back then, so it's starting the first, second, third. It's like, oh, here we go, and then you hit 100. It's pretty cool. And I don't know if obviously people can't see this on their end, but we do have a lot of our team in here, so that's a little bit awkward as well.
I think the word is special.
So, yeah, exactly.
Well, guys, let me ask you, looking back from where we started, we're going to just dive right in. So I want to ask you some questions. If you're looking back, what are some of the biggest philosophy changes that you've seen? What are some of the biggest shifts in mindset that you guys would see as far as retirement planning from when you did your first episode? Because obviously a lot of things have probably changed, and you guys have experienced different things. So what are ways that you would say that are, some mindset shifts that you've had?
I think the biggest thing personally is the importance of sort of the mental health, and not mental health in the sense of psychology, but more about the preparing people mentally for retirement. Because, when you have a market loss and you're retired and you no longer have that working income, that can cause a lot of stress, that can cause a lot of, pain, and people will no longer enjoy their retirement. If something like that happens at the same time that they're retired, that they no longer have a job, or if there's like a big renovation. Right. So when you start to look at it from the mental aspect of it and just making sure that people are prepared for the roller coaster after they have retired is something that I think really becomes a bigger part of the planning process than it used to.
Okay.
Yeah, I would say, Laura, interrupt there. And when we started, it was all, I remember like back in the day, it was all income is king, income. And it still is. You can't retire without income. But that was like 15 years ago. That's where our planning started and stopped, was around having enough income for the rest of your life. And then, so I think just what's evolved is there's like so much more to planning. And every year it becomes even more comprehensive in terms of what's involved in a plan for a client. It used to be, okay, make sure they have enough and they're good to go. And now that's like 1/100th of a plan. Yeah. So I think that's kind of the biggest difference.
Yeah, and I would say the emphasis around taxes and tax planning, that's really come to the forefront, specifically here, being able to better position both our clients as well as their families long term to have what we believe to be a better tax horizon. So, yeah, I mean, tax planning, I think, has really come to the forefront here.
And just to add to that, because obviously it's very current, I mean, here we are at the 100th episode. I think private markets are playing more and more of a role under the investment management side of things, where if we went back, even when we were doing radio, much less the first couple podcasts, private equity, private credit, infrastructure, things like that we knew what they were, but didn't really availability and working it into portfolios was not something that we had done as much. And so now here we are at the 100th anniversary, 100th podcast. It's a completely different story.
Yeah.
Where now we can really go anywhere with the portfolio side of thing to drive those income, to do that tax planning, and to really round out the plan.
Yeah, that's really good.
Maybe by like our 200th episode, we'll be able to afford 4 microphones instead of Keith and I sharing this.
No, it's very cute though. I love
It's
it. It's almost
cozy.
like backup
Take turns.
singers. I love it. Yeah, this is great.
Well, Matt, I think you made a really good point and a good segue for us to talk a little bit about investment lessons that you've learned over the years and over the 100 podcasts, not 100 years. So one quick question I want to ask you guys is maybe what's something that you would find that's underrated that a lot of people kind of don't consider when it comes to risk?
Would you guys like to take that one or no? Was that directed towards me?
I think that was more the investment committee guy.
I see. I think it's overall volatility. I think the experiencing volatility or managing volatility is so crucial because that's the ride. I mean, think about the roller coaster people talk about. Volatility are the rails themselves, where if you have a high volatile or highly volatile or very risky portfolio, you're going to have significant ups and downs and drops and things along those lines. Where if you have what's called, and here to get nerdy, good thing I wore my glasses, so I was perfectly ready for this.
And the sweater.
And this sweater, St. Andrew's Cross, baby. For anyone that's been to Scotland, let me tell you all about Scotland. I'm not sure if this is the podcast to talk about it.
No, it's not.
But we could talk about St. Andrews. This guy wants to talk about St. Andrews if he could.
I was more interested in standard deviation.
Which I think is a lie because he'll talk golf anytime. But the idea of measuring that. I mean, you could take all of these holdings, you could take clients' holdings, and you can analyze them to break down like how wild of a ride is it going to be. Now you can go down to what's called a risk number, which kind of simplifies it on a scale of 1 to 100. You can get to that next level of deviation, standard deviation, which is also kind of just another mathematical way of measuring it. But the whole goal is to find the ride that the client is comfortable with, and that's appropriate for what they're trying to accomplish and what their income goals are and growth goals are. But you can really narrow that down. And so that just helps with the expectation of going forward. Where if a client's looking or saying like, hey, I'm good with risk, and you set them up in that portfolio, and then they call you upset when the market drops, like, buddy, you asked for this.
Yeah.
Right? So you can help manage their expectations going forward by really keeping an eye on all of those metrics.
Zach Perkins and I had a meeting recently, and he's a CFA, and it's the high, I think it's the highest one of the credentials you can have as an analyst and portfolio manager. And so I brought him in, and I'm telling the client like he's a lot smarter than me in this area, which he figured out real quickly that I was not lying. And he was like, but going through the process, Zach helped design an awesome plan. He came into some more money. And the bottom line is, like Matt said, it's like you can say, oh, I want these double-digit returns. I can't wait to grow my portfolio. But we always show like what a downside would look like. Because if you panic in a downturn and the loss is too much and you sell, it's over. Like you're just not going to recover. We've seen a few people over the last 20 years do that try to time the market. It doesn't work out. It might work out for a week, a month, a couple months. In the long run, you can't. So the main thing around risk is making sure everyone knows where they stand and what's possible on the downside, so that if we hit this, are you going to panic? Because if not, we have to reduce it even more, the overall risk.
Yeah, like Derek just said, panic isn't a strategy. So you got to be sure to quantify risk. How we do that is through the risk numbers and allowing people to understand what conservative means, what moderate means, what aggressive means, and actually putting numbers to that. So then they understand where they sit. And then during review meetings, reviewing that with them, because as portfolios grow and, maybe the risk numbers come, go a little bit further than what they were comfortable with, it allows us to realign the portfolio and more or less gauge, hey, are you still comfortable with this? You're a few years older. You don't necessarily need to take the risk. Do you want to? You know what I mean? So I think, like I said, quantifying risk and being in a place where the market, does go down, you're not panicking, because that, like Derek said, is, you're doomed at that point.
Yeah. And Keith, what would you say is one of the biggest shocks people see sometimes coming in from an outside perspective when we're looking at other accounts that aren't under our management and they see their risk for the first time?
Yeah, there's been so many times when you're sitting with someone and identify themselves, I guess, for lack of a better way of putting it, as conservative. And then you do the analysis and they're more moderate, aggressive, or aggressive. And you show them the potential up and down, and they love the up, but they don't like the idea of losing, 25, 30, 35% of their portfolio. So it's a bit of a shock, and then it's our job to help realign and align them with their risk goals.
Yeah. And that falls in line with what we see a lot is the difference between having a portfolio versus having a plan. So how would you guys say that mentality fits into the picture as well?
Yeah, obviously, that's kind of the common theme as well. And we talk about this a lot with myself, Paul, Natalia, Laura, in my meetings, is like most people that come in for the first time, they have just this bucket of, basket of statements. Here's my, this company, that company, 401k, but what does it all mean? Do you have a portfolio or an actual plan? And I always tell people, like, the difference between, and this is obviously this team that's around us right now in this room and some that aren't here, we say this, but it's such a true statement that we are a result. The success at SHP is a result of the team, because when I look at other companies, I say you probably have two choices. You can go with like a big, huge wirehouse type company. You might get another advisor every couple of years because they move in and out of different roles in the company. Probably get mostly portfolio management, very little planning. See them once a year, and that's it. Or the other side, you might have like a mom and pop shop, kind of like we were when we started 20 something years ago. People that really care, good people that are out for your best interest, but they don't have the infrastructure to deliver on more than just a portfolio. Because we started that way. We didn't have the infrastructure. So I think that's the benefit. What we saw as a concern is what we built around, which is having the infrastructure for our clients to come in. And no, it's not just about me or Keith or Matt or any advisor. It's about us managing the plan, but having a team on the planning side, a team on the portfolio side, all working together for that client. And so I think that's a secret ingredient here at SHP for the last 23 years is that type of structure, to still have that small town, family feel. When you walk in, you see Giselle, who's been with us for 20 years.
She's the mayor of
Plymouth. Giselle, you were like 15 when you started, I think. But now that's what they, you had that feeling, but we can now have the team behind us to just have that support across the board.
And I think too, Laura, what kind of motivated that was that we were looking at what were called family offices back in the day. And what family offices are like sort of like a firm that only works with extremely rich, wicked high net worth, think like Roosevelts and Kennedys and different things like that. Oh, the Gregoires and the Ellises, I would also stick on that list. And so I was talking to some of my buddies that worked for these firms, and I was like, okay, what do you do? And they say, okay, well, we do income plans for them. We do investments, and we do taxes and manage charities. And I'm like, okay, well, how come no one's doing that for more the blue collar or people that have saved, that have done all the right things? Here they are, $1 million, $2 million, maybe $5 million that they've been able to save, and no one was doing those things for them. Maybe they were doing portfolios for them, like Derek and Keith were talking about, but they weren't going that extra mile. And everyone deserves, and not just deserves, but needs that type of planning, because if not, you're going to pay excess money in taxes, or you're going to lose more in the market than you should, or panic because you don't have a plan. And I think that really drove us, was to make sure that people of all shapes and sizes get the planning that they deserve.
Yeah, that's awesome. All right, guys, let's pivot a little bit and talk about some lessons that you've learned around taxes. Now, obviously, we live in Massachusetts, so we've learned a lot of lessons. So the first one I'm going to throw at you, I'm going to pick on you, Derek, because I know you love taxes. So what would you say is a lesson that retirees learn too late when it comes to taxes?
They should have moved out of the state a long time ago. No, I'm just kidding. Kind of. We do have some people that will say, oh, I should move every time we talk about taxes. Well, if I was in Florida or New Hampshire, we had someone this morning, I would avoid $3 million. Yep. So the only difference is for me living here, I have to pay that where I wouldn't somewhere else. And so, but I always say you don't want to like be miserable in New Hampshire by yourself just to save money. Like right. It's not worth it. But at the end of the day, but I would say,
is Nick Nelson here? Because he's from New Hampshire. He might, You might disagree with that, but keep on going. Keep
That's
on
a
going.
good point.
No,
That's a good point.
You know.
But what was the question around lessons around taxes?
Yeah, some lessons that they learned too late.
Yeah, I think just a lot of times, a very simple one is, even though there's still some things we can do when someone's retired, especially when they're getting ready to pull all their minimum distributions off their IRAs. Between Keith, Matt, and I, and the advisors in this room, we'd probably have $1 million if we had $5 every time someone said, "Oh, I wish I came to you guys 15 years ago." Because there's so many things we could do. There's still a lot of things we can do, but a lot of times, most folks come to us, they've saved in this big 401k IRA. It's all pre-tax, and now they're forced to take money out, minimum distributions, where if we can get ahead of it, there's so much more we can do if we can get 5-10 years of planning involved.
Yeah, and just to chime in too, sorry, Keith, if you were about to say something, I think that's one of the biggest things that's changed in our careers too, was that or at least there's much more awareness now that 401ks and not having Roths, like I think when we first started, like, oh, you got to do an IRA, you have to get that tax deduction, do whatever you can to get that tax deduction when you're working. And I think everyone now knows that it really isn't the best thing you can do, because you're spending, you might not spend as much as you did while working, but it's pretty dang close. And so, in other words, your tax bracket is most likely going to be similar to what it was while working. And so the idea that you come into retirement, like Derek was saying, with close to 99 or 95% of their retirement money in pre-tax dollars, it's just people realize that the mistakes that they may have made 10, 20 years ago.
Yeah, and they kick the can down the road into an unknown tax rate. You know what I mean? That's not good planning. But I would say the Massachusetts estate tax, I think a lot of people really don't know that much about it, and different ways to potentially cure that, whether it's irrevocable trust, gifting, ILETs, things along those lines. So, a lot of people think their trusts also do cure it, or they, satisfy the need for long-term care, not to go down a different path. But, these trusts aren't like magical pills that cure taxes and healthcare issues, things like that. You have to really know what you have, and then do the proper planning on top of that trust to mitigate, the inevitability of what you're going to have to pay. So,
yeah, that's really good. And to go back, because you guys really talked about pre-tax money. So the big thing a lot of people are talking about now is Roth conversions, right? And everybody's a little trigger happy with them. But what would you say is something that is a misconception about Roth conversions that maybe people don't know about, or should at least have professional management before they do that?
I got one that I hear all the time is, a lot of times people think that by doing a Roth conversion, like, they have less money working because their dollars are less. But in reality, they just, no matter, even if they grow their current portfolio now and it's pre-tax and it goes from $1 million to $2 million, right? Well, if they owed 40% of it at $1 million, they'd owe $400,000. If they now have $2 million, they owe 40%. It's now $800,000. So they think like, oh, when I do that, I'm losing my growth potential, but you're not, because as your portfolio grows, so does your tax liability. So that's one thing people, I think, have a misconception on. And then the other thing around Roth conversions is, it's funny, during different, I remember years ago, someone asked, "Do you guys still get paid when the market's down?" And I was like, we should get paid double, because that's literally during 2020, I'm sure there'll be another one coming up during COVID, during 2022. There's plenty of these times where when the market's down, that's when you can do a ton of planning for the long run around tax loss harvesting, Roth conversions, converting at a lower point in the market to a Roth and having the recovery happen tax-free. So there's so many cool things you can do. Even when the market's up, everyone's happy. When it's down, it actually creates a lot of planning opportunities. Another misconception.
I think the one that I would chime in on is, I think there's misconceptions in regards to how much or how little you can do, where people think it's almost like kind of all or nothing. And it's like, well, no, you can do a little bit at a time. It doesn't have to be the same exact amount every year or anything along those lines. You can really actively plan individual years. And if this year is a big year because you sold a property or whatever that may be, maybe that's a year you don't do it. But maybe the following year is a lower income bracket. So I think just taking each year individually and not thinking it's all or nothing, I think that's a misconception we clear up a lot.
And I would say people start taking their required minimum distributions and don't think that they can convert on top of that. So there's still an opportunity to better position yourself from a tax perspective, even though you've started your required minimum distributions. It doesn't prevent you from planning.
Yeah, all good stuff, guys. Let's take a few minutes now to talk a little bit about the planning pillars. So, estate planning, healthcare planning, all that good stuff. So, Keith, you kind of mentioned this earlier, so I'm going to pick on you for a few moments. But what's one estate planning tip or estate planning gap that many families might need or that they might be missing from what they have in their plan?
Oh, it can get complicated. I like to talk to people quite a bit about the estate tax and how to solve for it, right? And one of the best tools that I like to show folks, whether they get it or not, is ILETs and the use of life insurance to be able to pay the taxes, what I believe to be pennies on the dollar versus dollar for dollar, right? So I was meeting with a gentleman earlier today. His estate tax is probably going to be right around $1.5 million upon death if he continues to live in Massachusetts. And, he could buy a life insurance policy, excuse me, for $30,000 a year. And, to me, if he lives another 20 years, okay, that's $600,000 for $1.5 million tax-free that basically would pay that estate tax, and you have that plan in place, it's set. So if something happens to him between day 1, day 20, year 25, it doesn't matter. That plan's set, and the kids aren't in a rush to sell assets, make decisions that, I don't want to say are reckless, but can be reckless to pay that estate tax. So it's a unique way for folks to use leverage to be able to satisfy something that they're going to have to pay at a lesser cost.
Yeah. I would say a simple one too is just making sure your ducks in order for like beneficiary designations. It sounds like a basic one. It's part of estate planning, but you'd be surprised at how many people come in and they're like in their 60s and their beneficiary is their mom or their dad. You know what I mean? Like just older stuff that never got revisited from an old account. And like that could cause a lot of issues if it's not corrected. So just a simple thing, make sure your beneficiaries are lined up the way you want them.
Oh, that's really good. Okay, Matt, I'm going to pick on you for a second.
All right, I'm
Let's
ready.
talk a little bit about some lessons that you've learned about Medicare planning, long-term planning, all of the healthcare stuff, all the fun stuff. You get the good one.
Well, I think when it comes to the first thing I can think of is the lack of budgeting for it. Yeah, so I'll actually have two answers for you, Laura, if you don't mind. Number one is just the lack of budgeting for it. I think people will kind of go into retirement and they'll say, okay, well, I know Medicare is covering a large share, so I don't need to worry about the costs, or I know it's going to be a lot less, so I don't need to sort of even consider it. But even with Medicare and two spouses, I mean, you're probably paying close to $1,000 or potentially $1,000 a month in different premiums, whether it's through Medicare Part B or D, and then prescription drugs and so forth and so on. So I think there's a lack of accounting when it comes to Medicare altogether. And then, of course, IRMA. That's a big one where if you have certain income brackets, and it starts at about $220, I think, for a joint, at least at this recording, where your Medicare premiums will dramatically increase at each income level. And it's like different income levels than your tax brackets, so it's really difficult to kind of keep track of them all. But I think just planning for the costs and knowing that those costs can significantly escalate if they're earning, or if their modified adjust blah blah blah, your MAGI modified adjusted gross income is over a certain amount. So it's something that you really need to account for and be ready for.
Yeah. Anything else on your guys' end for that?
I think you covered it.
Okay. So one final area in the planning pillars would be charitable planning as well. What are some new things that you've seen here at SHP that we do for charitable planning that maybe we didn't do on episode 1 back in the day?
Yeah. A couple basic ones is one is donor advised funds, just basically, or people call them DAFs. It's a way to take appreciated holdings, securities, whatever, and gift them to a fund, in essence, that then you can gift to charities. So if you bought, a lot of times people would be making donations like, yeah, I gave $30,000 to XYZ last year. And it's like, where'd you pay that from? Oh, I just wrote it out of my checking account. Well, it's like, well, what if you had bought NVIDIA for $1,000, it's worth $30,000, you could then gift that $30,000 to the donor advised fund, get a full deduction, and then use that to pay out to 1, 2, or 20 charities going forward. So you're taking almost not bad money, but money that has internal gains. And if you want, you could buy it right back if you wanted to with 30,000 and have the basis be 30 instead of 1,000. Not to I'm getting complicated here, but it's a really good way to donate money if you're doing it already and use appreciated stock. And then the other one is obviously the QCDs. If you're 70 and a half, or if you're RMD age 73, and you wanted to take some of your IRA, you can donate. If your RMD is 100,000, you could donate 10,000, 20,000. It'll reduce what you have to take out, and the charity is getting that money. So in a scenario, this is kind of like a severe way to look at it, but if you took $100,000 out of your checking account, right, and gave it, that's like taking $150,000 out of your IRA. You know what I mean? So where if you can just give $100,000 out of your IRA, the charity gets the same amount, and you're able to save some money for another charity or for your own use or whatever. So just a couple ways: donor advised funds, QCDs, few ways to distribute money to charities, but at a much better tax efficient way.
And just real quick, just to kind of chime in, what I love about all this, Laura, is imagine all of these tax planning strategies, excuse me, all layered on top of each other, right? So, okay, if we're doing a Roth conversion, well, that might be a good year to do a DAF or to do a QCD. Or, okay, if same idea on Roth conversions, and we're still looking at estate taxes being a certain level, Keith mentioned ILETs and whatnot. I mean, we have all these tools now at our disposal that sometimes we bring all of them to bear, sometimes just one or two. But it's just having, again, being armed in all that way and, combining and finding how the puzzle pieces all work together is just a lot of fun.
That's awesome. All right, guys, last segment we're going to talk about is to talk a little bit about behavioral finance. And I think one area that SHP is really strong with is that we really bring a lot of the, human aspect back to how people invest. And when people come in and sit down with us, they say, wow, I didn't think of investing in this certain way. Or we get a lot of feedback from our clients saying how much they really appreciate how we break things down and understand things very clearly and help them, with risk, all of that good stuff. But what would you say is an area that maybe some people come in with certain bias about investing that sometimes we have to unpack or help people change their point of view on?
Hopefully this is answering the question, but I think that so many folks have this money and they don't know they're kind of paralyzed on how to retire, what to do, because they've never seen it play out. So two strategies that we use a ton around behavior and so forth is one, the risk factor, like showing them what their risk score is from a 1 being no risk to 99 being very high risk, but also using our SHP client portal. Like, I think that gives them so much clarity, our clients, because they can see, in clients that are listening know, if you're not a client, envision a place you can log in, see all of your accounts every day, tied in, updated every single day. Also, tied to your plan and goals. So you can kind of see, am I on track? What does it look like? Am I going to run out of money at 90 or am I good to go? Can I buy a second home? Can I buy a second car? Whatever it is. So I think just they get a lot more confident in getting to or through retirement, having some of these areas that they see and can visualize and actually use to their own situation that they never have before. Because before, it's just I have these statements, I have money, I know I have the expenses, but I don't know how it all works together. And those two things really tie it together nicely for them so that they can have that mental clarity on moving to and through retirement.
That's really good. And what would you say maybe in your experience are some situations where you've met with someone who can't let go of those biases and, maybe it derails their plan? I mean, what type of situations are you seeing in that?
Well, I'd say some people just they've been so conditioned to save
that
it's hard for them to spend.
That's good.
So it's like I get it. It's almost like we have to remind everyone who comes in that retires, which happens a lot. It's like we have to remind you that it's okay to spend money. Like you've been so good at saving that it's hard to it's hard to stop saving. So wait, I can use this money now because I've been conditioned since my parents taught me when I was 3, 5, 7, like paper routes, this, that, and the other, all the way to I'm 65 or whatever you retire is save, save, save. And now it's like, now I can spend it. It's a huge mentality shift that people have to really learn.
Yeah.
I'm sorry. Some of the people in the room are wondering what a paper route is. Could you explain what that is?
A few people here though. Yeah, that's a good point. Did you have one?
I did. That was my first job ever.
Yeah.
I got chased by dogs once, and it was a terrible experience.
Michelle, you
I'll
had a
never
paper?
forget it.
Yeah. I didn't. Did you?
Yeah, seriously. They're like, that's not even a stereotype. That's a fact.
Yeah.
Sorry to bring it back real quick. One sort of bias I do want to talk about, and to be a little negative, well, not to say negative, but especially where we are right now, is the overconfidence bias, right? People will come in and they'll just say, well, I've been managing this money and look at how I'm doing. I'm doing 20% rate of return. And it's like, dude, everyone's getting 20% rate of return in 2023 and 2024 and 2025. Like, we're on a ridiculous string right now of returns. And people will come in and be like, well, I don't need to hire a professional to do that plan that Derek just talked about or do this tax planning. I could do it all myself. And it's like, I have to sort of remind people, it's like, look, yes, the good times don't always, they will end at some point in time. It's always cyclical. And if you don't have somebody, a professional, that's either managing the taxes on your behalf or putting together that portal or talking about estate planning or whatever that may be, this little run's going to come to an end. And then you're going to just, you're way over your skis and you're just going to fall on your face. And I think that part kind of obviously frustrates me because, we spend how many hours a week? This is a full-time career advising. And if you want to spend your retirement that way, God bless.
I used to say that, Matt, but you can't anymore. So
how so?
Here's what I'm saying you can't in a way that it shows how much value, because I used to be like, oh, if you take your whole retirement, it's all you want to do is this, you can do it. But I don't think you can anymore, because even if I took every hour of every day, I still don't understand the stuff that Alina and the planning team knows on the planning side. I still couldn't talk anything with Zach and Cam and all you guys and Dave on the portfolio side. So even if you knew as much about portfolio management, you're able to dissect all that and then learn every single act of Congress and changes. And so I used to be like, yeah, if you want to devote your whole retirement, good luck, and you can do it yourself, but then you don't get to do the things you want to do. Even if you did as one person, I don't think it's possible to have every I dotted and T crossed. I don't, because we started I think it further takes what you said to another level of like, if people out there that are do-it-yourselfers, yeah, you might be able to do part of it, but can you hit all these angles of a plan, which might be 20, 30, 40 parts? Probably not. So don't take it for granted because the market's going up and it covers all the blind spots and all the bad mistakes, because again, if you're not doing all the little things across the way, you're going to miss out in the long run. And when things start going the other way, you're going to feel it.
Yeah. All right, guys, I'm going to hit you with some rapid fire questions now. Do you think you can handle it?
No.
Rapid.
All right, ready? Whoever wants to go first, just give me a quick one-sentence answer.
Yeah,
just
straight
really
to
quick,
Keith. Straight to Keith.
Right
Okay,
to Keith.
there
All
it
right,
is.
Keith. What is one financial lesson that if you could go back and tell your 25-year-old self, what would it be?
Invest in Roth.
All right, another one. What's the most overrated financial tip?
Oh. Wow, you put me on the spot. There's a lot.
I did.
Can we edit this? I'm just kidding. Rapid fire, Matt. You want to take that one?
I mean, no.
Yeah. Keith? There's a lot of good tips. I feel like even start saving early is a cliche, but it works. You know what I mean? So.
All right, you guys don't have one. Good, I stumped you.
Yeah.
Nice.
Yeah, because a tip usually implies it's a positive thing, and you can't say what's a bad tip,
Yeah.
right? I don't know, less than 15%.
Oh,
Just-
I know one.
there you
Put
go.
everything into your maximize your 401ks every year, because
All
it
right.
depends on the situation.
Right.
Maybe
There
we
you
need some
go.
Roth. Maybe we need some Roth mixed in.
All right, you passed.
That was close.
All right,
Thank goodness.
Yeah.
another rapid fire. What's one thing that you could do now to really bolster success 10 years from now? One financial tip or trick.
So, all right, but how old? I mean,
No, don't analyze, just go, rapid
Am I
fire.
in my mid-40s? Like, what
Yeah,
am I talking about?
Let's say mid-40s, sure.
All right. I think it's similar to what Derek was mentioning, which is just have those buckets established. I think one word that we do use a fair amount is what's called two words, but tax diversification. We talked about how people will come down and will see us and they'll have all pre-tax and like a little bit in after-tax money. I think it's more making sure that as you approach retirement or really any time, have money in after-tax dollars. Some people call them brokerage accounts or whatever that may be. Have money in Roth IRA. Have money in pre-tax dollars. I mean, you might want to have some to get those tax write-offs, but have a little bit in each bucket because you'll need something in each bucket depending on what the circumstances are in the future. So really start to take a look at, okay, how am I allocating my savings, and in a perfect world have pretty good, or as much as possible, have a very diverse tax situation just as much as a portfolio.
Yeah, I think one
easy
lesson
answer
we
is-
could say is we've learned that you guys can't do rapid fire.
Rapid fire.
Let's go. Prove them wrong.
Don't have kids, they're expensive.
Fair enough. He's not wrong.
Just ask Matt.
I'm not sure if I can co-sign on that. This is, yeah.
It's a good financial tip.
Yeah, they're in theory, yeah.
All right, guys, let's close this out. What I want to ask you guys is maybe each of you could just share for 1 minute or so something that you've learned and that you'd like to impart as kind of like final words of wisdom for what you've learned over the past 100 episodes.
No, I've used this. I think it's just a good thing I've used in it around faith, around anything, around family. It's like doing things. If you pay attention to the small details. I remember when people know I'm close with my dad, and I don't know if Giselle remembers, but when we were doing we renovated the downstairs office here at SHP, and I remember like my dad found like a penny on the ground. And he wrote me this whole long thing about like how I can imagine how much money you guys have managed and dealt with over your life. And he's like, if you remember one thing, if you can take care of the small things in business or in life, the bigger things will take care of themselves. So I think if you can take care of the little details, right? Like if you're on a weight loss program, you don't just like, oh, I'm going to lose weight. You starting by eating healthy, go to the gym once, twice a week, and then you start doing, stacking that up. But it's all the little details. It's not just, oh, I just did this. Well, I guess now with a shot, maybe it is, but normally, but in any but just like financial planning, and just like we talked about earlier, if you can take care of a lot of little things around taxes, around estate planning, around risk, guess what? You think of your odds of having a much better retirement, right? It's just simple. So take care of little things in life. The bigger things will work themselves out.
What was the question? I forget.
All right, Keith. So if you could
What did
just
you learn?
impart one final lesson that you've learned over the past 100 episodes that you want to share with the listeners.
About the podcast?
No, just in life and financial planning, anything. You'll learn.
I wish I don't know, started collecting cards earlier. It's because they're worth a lot of money now, and that's my thing.
All right, just tell us your favorite card that you have.
Investments. How's that?
The listeners are going to learn everything from that.
If you have sports cards, hold on to them and let me look through them. They're worth a fortune.
All right, we know Matt's got some good wisdom. He's always good for it.
What I was going to say was just the Well, yeah, he kind of stole my thunder. But I think, and Derek kind of mentioned it earlier, I'll just kind of highlight the importance of teams. I remember whether it's podcast wise, about all the work that goes into putting the podcast on, whether it's, Jamie, who's been helping for years, Evan, who still, I think, assists here and there with the editing and then the production of it. I mean, it just shows, here's that one example, right, in this, podcast, how 100 ones, but there's so much that goes into it. Right. Or when you and I record the markets on the move, it's so much better, not only when you have the team behind, but then doing it with a team as well, or other subject matter experts or whatever that may be. Because, when you work together as a team, it's like not only it's like the sum is greater than the parts, right? Where, okay, I just learned a whole lot more because of who I just spoke with, whether it's personally or professionally, and now I'm better off, and then he or she is better off because we all kind of, collaborated. And that trickles down everywhere, right? Whether it's the investment committee like Derek was talking about, or whether it's the I'm not going to name my team name right now because we have an internal name and it's not the Patriots, and so
it's the Seahawks. I'm going to call you guys out on that one.
It's the worst possible bad timing on that one right there. But here we are. I mean, like, managing. There's a lot of clients that we work with, and I, obviously I can't do it alone. Yeah. And when you surround yourself with other rock stars, it's amazing what you can do. And I think SHP in this podcast is an example of that.
So Matt, are you trying to say teamwork makes the dream work?
Yes.
He
I
has
literally
that
could have
tattooed on
just
his
said
back,
that.
actually, if you didn't know.
Yeah, rather than going on, prattling on for 10 minutes, I could have just said dreamwork, teamwork makes the dream work. It's a fact.
I'm kidding.
You guys are awesome. Well, first, we want to take a moment to thank you for 100 episodes, and definitely takes a lot of time, a lot of effort.
Keith did at least 2 of those.
He did at least 2, thankfully, yes. But we
Both
appreciate
are the
it.
most listened to.
We know the listeners appreciate it, and we're really excited to see what the next, maybe we'll say 50 episodes will be our next big milestone. And I think it's been pretty cool to watch from, the perspective of the team is that you've brought on so many incredible guests. You guys really have expanded the voices that come on, and we are all really appreciative of that. So thank you guys for 100 episodes. Thank you to our listeners. You guys are amazing. Thank you for anyone who's really committed and listened to a lot of the episodes and got a lot of wisdom. So we're so excited to see where the next 50 episodes take us.
Thank you to the team for joining. That's all. Okay.
Thanks for listening to the Retirement Roadmap podcast by SHP Financial. If you've enjoyed today's episode, be sure to hit the subscribe button so future episodes are automatically downloaded directly to your device. And if you've liked what you heard, please share the show. Create your own little ripples so we can help even more people with their retirement goals. If you want access to all past interviews, including notes, resources, and exclusive content from SHP Financial, visit shpfinancial.com/podcast. Thanks again for joining us on the Retirement Roadmap podcast. And for all the attorneys out there, and disclaimers and disclosures, I'm just going to put on my super serious voice and add our own. No statements made during the Retirement Roadmap podcast shall constitute tax, legal, or accounting advice. You should consult your own legal or tax professional on any such matters. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk, and unless otherwise stated, are not guaranteed. Our investment advisory services are offered through SHP Wealth Management, LLC, an SEC-registered investment advisor. Insurance sales are offered through SHP Financial, LLC. Our advisors and insurance reps may offer clients advice and/or products from each entity. No client is under any obligation to purchase any insurance product.